Welcome back to the Deep Dive. Our mission today, well, it's laser-focused and tailored just for you. We're cutting through the noise, diving strictly into the recent financial assessment of one of the world's largest payments companies.
Exactly. We're looking exclusively at the chief financial and operating officer's prepared remarks from their latest earnings call. Think of it like a military briefing, right? What did the Financial Command Center actually report for Q3? How healthy is that balance sheet? And crucially, what's their guidance for the critical holiday quarter ahead? This is pure financial intelligence.
Okay. And if we look right at the top-line summary for Q3, the message seems to be one of renewed speed, almost. The company didn't just grow, they showed real acceleration, build momentum.
Yeah.
It feels like confirmation that this huge strategic transformation they've been talking about is, well, finally bearing fruit in the actual numbers.
It really is a story of stabilization and, acceleration. Let's look at those foundational metrics. Total payment volume, or TPV, as we'll hear it called, crossed $458 billion. That's a huge number. And both TPV growth and overall revenue growth, they sped up by 2 full points compared to Q2. So TPV was up 8% outright, or 7% when you adjust for currency fluctuations. Pretty strong.
What's really interesting here is how that volume translated into core profitability. Because volume is one thing, but margin is another. The key metric we always track is transaction margin dollars, excluding interest income. And that grew 7%, maintaining the pace from earlier this year.
That's right, 7% growth there.
So the question is, was that driven by just one hit product, or is it something more, systemic?
It definitely suggests stability through diversification. Management pointed to really broad-based growth. We saw strong credit performance, good flow-through from their branded checkout, improvements in profitability from the PSP side, that's payment service provider activities, and, importantly, accelerating monetization of Venmo.
Okay, so multiple engines firing.
Exactly. It's not reliance on just one vertical.
It looks diversified on paper, sure. But if credit suddenly goes sideways, which can happen, doesn't that diversification kind of crumble a bit? What's the biggest vulnerability they mentioned when generating that margin?
That's a very fair point. While the growth was strong, it was partially offset by higher transaction losses in the quarter. And this speaks to maybe an operational vulnerability. The CFO specifically called out a 1.5-point headwind. That was due to lost provisions from a temporary internal service disruption back in August, mostly impacting Germany, it seems.
Wow, a 1.5-point margin hit just from a service interruption. That sounds potentially systemic, not just, bad luck. Did the CFO offer any specific guarantee that those redundancy issues, those stability problems, are now fully addressed?
Well, they described it as temporary and isolated, but you're right, the cost is definitely visible right there in the Q3 numbers. The good news, I suppose, is that even absorbing that specific hit, and despite slightly lower interest rates impacting their balances, non-GAAP operating income still grew 6%.
Okay, 6% growth even with those headwinds.
Right. And that performance combined with share buybacks and a favorable tax rate drove 12% growth in non-GAAP earnings per share, or EPS.
Yeah.
Pretty solid bottom line growth.
Okay, so we've covered the money coming in, the top line, the margin, the bottom line. But, financial health doesn't mean much if the underlying customer base isn't actually engaged. We need to check the pulse there. If we move past just the sheer number of accounts, what's the quality indicator? What tells us customers are truly, habituated?
That's exactly why we look closely at customer engagement metrics, and probably the most important is usage depth. Monthly active accounts, or MA, basically the total customer base, showed steady progress, up 2% year over year to $227 million. Moderate growth.
Okay, 2% MAA growth.
But the crucial metric here, the one that really tells us about habituation, is transactions per active account. And if you exclude the PSP part, that metric actually accelerated to 5% growth.
Okay. That acceleration is the signal you want to see. It means customers are reaching for the app or hitting that branded checkout button more often. They're integrating the service deeper into their, daily buying routines.
Precisely. And you see that deeper engagement translating into real momentum in their biggest volume categories, too. Branded experiences TPV, that's when a shopper specifically chooses to pay using their system that grew 8% overall. So that specific choice, that volume, is speeding up.
Let's break down that branded growth a bit, because I noticed the U.S. performance really gained some significant traction.
It did. U.S. branded experiences TTV growth accelerated to a pretty robust 10%.
10% in the U.S., wow.
Yeah, and they attributed that acceleration to two main things. First, the growing success of their omni-channel adoption, shoppers using them both in-store and online. And second, just generally stronger online checkout trends, specifically within the U.S. market.
And what about those newer, maybe smaller physical world plays like tap to pay?
Right. Even though they're still a smaller percentage of the overall business, volumes for their debit card and tap-to-pay services, the ways people use them in physical stores, they sped up dramatically, up 65% year over year.
65%? Okay, small base, but rapid growth.
Exactly. And meanwhile, Venmo just continues to be a growth engine. TPV growth there accelerated 2 points to 14%. That marks its fourth consecutive quarter of double-digit growth. It's really becoming a significant contributor.
You mentioned earlier that strong credit performance drove profitability. Let's maybe circle back and look closer at that segment. Other value-added services, which they call OVAS, mostly credit services, right, grew a massive 15% to nearly $900 million.
Yeah, 15% growth in OVAS is huge. And what's really fascinating here is that this strong OVAS performance comes alongside a major strategic decision. They're changing how they handle credit risk. The company's actively moving toward what they call a balance sheet light model for credit.
Okay, balance sheet light. Why is that strategy important right now? Why would they want to shoulder less risk?
Well, it's crucial for, I'd say, two main reasons. One, it obviously de-risks their exposure to potentially rising consumer credit defaults, especially if the economy softens further. That's the defensive reason.
Makes sense.
Two, and maybe strategically more important, it frees up capital. Capital that doesn't need to be tied up provisioning for future loan losses. That freed up capital can then be returned to shareholders, like with the new dividend, or reinvested into competitive features to drive more growth.
And we saw pretty tangible proof of that strategy shift in Q3 with that Blue Owl deal, didn't we?
Correct. That was a big move. By externalizing a portion of their short-term U.S. pay later receivables with Blue Owl Capital, their net loan receivables actually decreased 8% just from Q2. Down to $6.4 billion. This is real, concrete action. It proves they intend to be more of an originator and servicer of credit rather than primarily a holder of the risk.
Got it. Okay, let's talk pricing for a second, or what they call the take rate. The overall transaction take rate declined slightly, 3 basis points down to 1.64%. They attributed this to shifts in product mix, merchant mix, FX hedging, the usual suspects.
Right, a slight dip overall. But, and this is important, it's worth noting that the online branded checkout take rates, arguably the most crucial part of their business margin-wise, remained relatively stable year over year.
But the core pricing power seems intact there.
Seems to be, yeah. Now, shifting to capital, this whole transition phase, the stabilization, the move to balance sheet light, it clearly gave management enough confidence to announce some major capital allocation news.
The dividend.
Exactly, the initiation of a dividend. Based on a 10% payout ratio relative to net income, it's a signal of maturity and confidence, really.
And this dividend, it serves as a complement to their existing share buyback program, right? Which remains the primary focus for capital return.
That's what they said. The buyback is still primary. They're targeting, I think, 70% to 80% of free cash flow for overall capital return. And they put their money where their mouth is in Q3, repurchasing $1.5 billion in stock just in that quarter alone.
They can afford to do both the dividend and the aggressive buyback because the cash position looks extremely strong.
Oh, very strong. They ended the quarter with $14.4 billion in cash equivalents, and investments. And adjusted free cash flow was robust, $2.3 billion just in Q3, bringing the year-to-date total to $4.3 billion. Lots of financial flexibility there.
Okay, so we've painted a picture here of, well, accelerated growth, strong diversification, healthy capital return, pretty positive overall. But amidst all this positive momentum, the CFO threw up a major caution sign, something that should probably worry anyone tracking the consumer heading into the holidays.
This really is the critical warning. It kind of anchors their whole outlook. While the number of checkout transactions saw relatively consistent growth, the key takeaway, the CFO stressed, is that basket sizes, the average amount spent per order actually began to decrease.
Decrease? When did they see that?
They noted this softening consumer discretionary spending trend appeared in Europe and the U.S. later in Q3, and crucially, they said it continued into October.
Continuing into October? That's not good heading into Q4.
No, it definitely warrants caution.
So, despite that caution, management still had enough confidence to actually raise their full-year guidance. How does that work? Let's look at that guidance raise.
Yeah, they did raise guidance, which shows that Q3 must have beaten their internal expectations by a decent margin. Full-year transaction margin dollar guidance, excluding interest, was raised. It's now in a range of $15.45 billion to $15.55 billion. That projects about 6% to 7% growth for the year. And non-GAAP EPS guidance was also raised, now projecting 15 to 16% growth for the full year, the higher targets overall.
Okay, but here's the paradox, right? They raised the full-year outlook, yet the projected transaction margin growth rate, specifically for Q4,
Yeah.
you said about 5% at the midpoint. That's notably lower than the 7% they achieved year to date. If things are accelerating, why does the immediate outlook seem to be decelerating?
Right, that's the key question. And there are three critical kind of interlocking factors driving that more cautious Q4 margin projection. First, pretty straightforward, they face normalizing credit comparisons or comps. Basically, they had a period of really strong credit outperformance in Q4 last year. So the year-over-year growth number this Q4 will naturally look a bit slower just because the comparison point is so high. Makes sense.
Okay, tougher comps on credit. Got it.
Yeah.
What's the second factor? This one seems more strategic.
Yes. The second factor relates directly to their strategic confidence in their long-term planning. Targeted investments.
Investing more.
Precisely. They are making a very conscious decision to begin increasing targeted investments in Q4. These are designed to amplify the impact of key initiatives, things they think will drive product attachment and habituation. Think global brand awareness campaigns, specific offers to get people using features more.
Okay, investing for the future. And this brings us back to that term that sometimes causes confusion, contra revenue. How does that play into the Q4 margin outlook?
Right, contra revenue. It's really an accounting choice, but it signals confidence. To put it simply, some of these new promotional costs, these investments, are directly linked to volume. So instead of recording the marketing cost as an operating expense later down the P&L, they're directly reducing the revenue they recognize right now, up front.
So it hits the transaction margin dollars directly.
Exactly. It's an accounting decision that makes their short-term margin, those TM dollars, look artificially depressed in Q4. But management clearly believes these investments will generate much larger, more durable volumes down the road.
Okay, but how risky is that? Increasing these growth investments, which, as you said, temporarily depress margins, right at the same time, the macro trend is signaling consumers are pulling back on basket size. Seems like tricky timing.
It definitely speaks to management's view that they must invest now for competitive advantage, perhaps before their peers fully react or match them. They seem to believe they have the financial strength, that strong balance sheet we talked about, to weather this temporary margin compression. But that inherent risk you mentioned is exactly why the third factor driving the Q4 guidance is so important. Just plain macro prudence.
The caution built in.
Yes. The guidance explicitly assumes a deceleration in branded checkout growth simply due to those ongoing softer spending trends, influenced directly by that decline in basket size they saw continuing into October. They're not ignoring the warning sign.
Okay, so summarizing the CFO's overall message then. The company seems to have successfully implemented its transformation. It's built on a solid foundation, showing broad-based financial strength, accelerating engagement, lots of good stuff. But they are approaching the end of the year with a, let's say, calculated, deliberate level of prudence because of this visible change in the macro consumer environment.
Yeah, that sums it up well. And if we connect this to the bigger picture for you, the listener, the financial commitment seems really clear. The company is leveraging its strong balance sheet to do two things simultaneously. Initiate that dividend, which pleases certain investors looking for a return now, while also reinvesting aggressively into core growth drivers. Think buy now, pay later. Think Venmo monetization. It signals they're playing the long game here, trying to gain competitive share, even if it means accepting a temporary, somewhat self-imposed deceleration in margin growth specifically for Q4.
Which raises a really important question for you to ponder. Given the CFO's specific, I'd say slightly unusual caution about the continuing decline in average order value, that basket size shrinking right into October, how might that specific trend signal a potential capitulation in broader consumer spending behavior as we head into the critical Black Friday and holiday season? That specific data point, the shrinking basket, that's definitely something for you to track as we move through Q4. We'll catch you on the next deep dive.